Right now, shares of Nuburu, trading under the ticker symbol BURU on the NYSE American, are priced at 33 cents, reflecting a sharp drop of 2.57% just moments into today's trading session. The stock opened at 37 cents and was immediately pushed down to this level, setting a tense tone for the day. While many investors looking at that sharp red candle might assume it's just typical volatility for a microcap stock, the reality is far more complex and points to a significant underlying battle being waged. The common perception of Nuburu is that it's a high-potential technology play, a company holding a key to more efficient manufacturing in the electric vehicle and electronics sectors with its innovative blue laser technology. The expectation is that this technological edge will eventually translate into major contracts and a soaring stock price. However, the market's current behavior tells a different story. The reality is that Nuburu is under immense pressure, not just from its own operational cash burn, but from a growing contingent of short sellers who are betting aggressively against its survival. The drop you see this morning isn't just random market noise. It's a reflection of a fundamental conflict between the company's long-term promise and its very immediate, very real financial fragility. Let's dissect the recent price action to understand the forces at play. The intraday chart shows a stark picture: a gap down right at the open and a failure to find any support. This kind of movement in a low-price stock often indicates a lack of buying interest to absorb the selling pressure. Volume is a critical indicator here. While not astronomical, the volume on these sell-offs tends to be concentrated, suggesting that motivated sellers are in control. For a stock with a market capitalization hovering around a mere $4.66 million, it doesn't take a large sell order to move the needle significantly. This makes it a playground for day traders and a target for those with a bearish outlook. We are seeing a pattern where any attempt by the stock to build momentum is quickly quashed. This isn't just about one bad day. It's a microcosm of the stock's performance over the last year, where it has bled from a 52-week high of 99 cents down to a low of 12 cents. The current price sits uncomfortably close to that low, signaling a profound lack of confidence from the broader market. This performance is happening against a mixed macroeconomic backdrop. While the push for domestic manufacturing and EV supply chain resilience should theoretically benefit a company like Nuburu, the headwind of high interest rates creates a punishing environment for pre-revenue or low-revenue tech firms. Capital is no longer cheap, and companies that are not self-sustaining are being scrutinized with extreme prejudice. Nuburu fits squarely into this category, and its stock chart is a clear casualty of this new market paradigm. This brings us to a critical factor that many retail investors may be underestimating: the significant short interest in BURU. This is not a stock that is simply being ignored, it is being actively bet against. The short thesis is straightforward and brutal. It centers on the company's financials. Nuburu is burning through cash at a rate that its current operations cannot support. This leads to the inevitable and dreaded prospect of dilution. To fund its research, development, and scaling efforts, the company will likely need to raise more capital. At a stock price of 33 cents, any equity financing would involve issuing a massive number of new shares, which would severely dilute the ownership stake of existing shareholders and put further downward pressure on the stock price. Short sellers are front-running this possibility. They are borrowing shares and selling them, hoping to buy them back at a lower price after a dilutive offering is announced or after the company's financial situation becomes even more precarious. For investors, it's essential to know how to track this activity. You can look at data points like short interest as a percentage of float and days to cover, which are available on many financial data platforms and even some brokerage interfaces. A high short interest percentage, particularly for a small company like Nuburu, indicates a strong bearish sentiment. Another key metric is the borrow fee rate, the interest rate short sellers must pay to borrow the shares. When this rate spikes, it means the demand to short the stock is very high, and the supply of shares available to borrow is dwindling. This can sometimes be a precursor to a short squeeze, but more often it's a sign that smart money is piling on the bearish side. The primary risk for shorts is, of course, a sudden positive catalyst. A major contract announcement or a non-dilutive funding agreement could cause the stock to spike, forcing them to buy back shares at a loss. What's your take on the rising short interest? Smart money or manipulation? Understanding the short seller's perspective is not about agreeing with them. It's about understanding the full spectrum of risks facing your investment. Ignoring the bear case is a luxury that investors in microcap stocks simply cannot afford. So what exactly does Nuburu do that inspires both such hope and such skepticism? The company designs and manufactures high-power blue lasers for industrial applications. This isn't just a matter of changing the color of the laser beam. The physics behind it is what makes it compelling. Materials like copper, gold, and other highly reflective metals are notoriously difficult to weld with traditional infrared lasers because they reflect most of the laser's energy instead of absorbing it. Blue laser light, however, has a much shorter wavelength and is absorbed far more efficiently by these materials. This results in faster, cleaner, and stronger welds. The application is immediately obvious and critical for the energy transition. Electric vehicle batteries, for instance, rely on thousands of copper and aluminum welds. Improving the quality and speed of this process is a huge value proposition. Nuburu's technology offers a potential solution that could streamline production for automakers, battery manufacturers, and consumer electronics companies. The company's demonstrated its technology's effectiveness and is working to get it adopted by major industrial players. The business model is to sell these laser systems directly to manufacturers. The challenge lies in the transition from a promising technology to a scalable, profitable business. This involves long sales cycles, intense competition from established industrial laser companies who are also developing their own solutions, and the need for significant capital to build out manufacturing and support infrastructure. Nuburu's history as a public company began through a merger with a special purpose acquisition company, or SPAC, a path that has been notoriously difficult for many companies. They often come to market with bold projections that prove difficult to meet, leading to a loss of investor trust and a collapsing stock price, a pattern that has unfortunately played out with BURU. Past performance shows a company struggling to gain commercial traction at a pace that satisfies the market's demands for growth and profitability. The narrative of a groundbreaking technology is powerful, but when it's not backed by quarterly revenue growth and a clear path to breaking even, the market's patience wears thin. Looking ahead, the future of Nuburu is a study of contrasts, a binary outcome with very little middle ground. The bullish scenario hinges on one or two major catalysts. The most significant would be the announcement of a large, multi-year purchase order from a top-tier automotive or battery manufacturer. This would not only provide a substantial revenue stream, but would also serve as a powerful validation of their technology, likely triggering a cascade of interest from other customers and forcing a re-evaluation by short sellers. Another potential catalyst could be a strategic investment or partnership with a larger industrial company, providing both capital and market access. Finally, non-dilutive funding, such as a government grant related to clean energy or domestic manufacturing initiatives, would be a massive win, allowing the company to fund its growth without harming existing shareholders. In this scenario, the high short interest could become fuel for a massive short squeeze, as bearish traders would be forced to buy back shares at rapidly increasing prices to cover their positions. But the bearish scenario is equally, if not more plausible, given the current financial state. The primary risk is and remains the company's liquidity. If Nuburu cannot secure a major contractor funding soon, it will face some very difficult choices. It might be forced into a highly dilutive equity offering at a price even lower than today's, an action that would punish long-term holders. A reverse stock price could also be on the table to regain compliance with the exchange's minimum bid price requirement, which often precedes further downside, as it's seen as a sign of weakness. There is also the competitive risk. While Nuburu's blue laser tech is impressive, they are not the only ones working on it. Larger, better capitalized competitors could develop a superior or cheaper solution, effectively closing Nuburu's window of opportunity. The company is in a race to time, and its own balance sheet is its most pressing adversary. Comment below how many shares of Nuburu you currently hold and what you believe is the single biggest hurdle for the company to overcome. In conclusion, the story of Nuburu is a classic case of expectation versus reality. The expectation is built on a foundation of exciting, potentially transformative technology that addresses a real-world industrial need. It's a narrative of innovation and future growth in sectors like e-mobility and electronics. The reality, however, is painted by the stark numbers on its financial statements and the unforgiving verdict of its stock chart. It's a reality of cash burn, financial vulnerability, and intense pressure from a market that has grown skeptical of promises and is now demanding proof in the form of revenue and profits. The battle for Nuburu's future will be fought not in the lab, but on its income statement and in the capital markets. For investors, the potential for a multi-bagger return is present, but it is directly proportional to the risk of a near-total loss of capital. The path forward will be determined by management's ability to navigate this treacherous financial landscape and turn technological promise into commercial success before time and money run out.